Another way we consider growth investing is to think about investing in initial public offerings. Initial public offerings can be considered growth firms because the very reason these firms are going to the market to access capital is because they want to invest in some sort of project or grow the business. Therefore, in this learning objective, we discuss evidence pertaining to the IPO Premium, and we think about IPO investing as a trading strategy. So there's a whole lot of evidence that tends to show that the subscription price for initial public offerings tends to be below the market price that these shares trade for at the end of their first day of trading. There's been a vast number of studies that looked at this issue. In the United States, it's been shown that across a sample of 13,308 initial public offerings, the average first day return was 15.8%. What this means is if you bought every one of those 13,000 initial public offerings, you would on average earn a daily return of 15.8% because the market price closes this amount above the price that you buy the stock for through the initial public offering. However, it should be noted that not every IPO trades at a premium at the end of its first day. About 15% of all initial public offerings are overpriced, which means these ones close the day at a market price below their subscription price. And there is some way that we might be able to predict which initial public offerings are going to be the ones that earn positive returns, because IPOs where the offering price is revised upwards during the offering, or those that are oversubscribed, are shown to be more likely to be the initial public offerings that have a positive return on that first day. So investing in IPOs is a short-term strategy that could be considered to be have some merit to a growth investor. However, as well as the fact that it's important to note that not all initial public offerings earn a positive first day return, therefore it's important for investors to be diversified across IPOs, it should also be noted that the performance of investing in IPOs is also time varying. So the IPO premium is on average higher when the general market is doing well. An example of this is during the dot-com bubble around the turn of the millennium. During this time, we saw a huge IPO premium. This investment strategy performed very well as there was a huge rally in the market and lots of IPOs issued during this time. Now, it's important to note as well that IPO investing is a short-term strategy. That is, that to profit from IPOs, you do have to sell the stock quite a short time period after listing, because there's actually evidence that over the long run, that is 5 years post-listing, IPOs tend to actually underperform. So while we've got a short-term positive abnormal performance, we have a long-run negative abnormal performance. As with any investment strategy that requires frequent turnover, this is going to incur transaction costs. So thinking about the idea that the IPO premium varies across time, what we've plotted on the screen here is the average IPO premium, or the average one-day return that's generated by investing in this strategy across years from the 1960s through to the mid-2000s. So we can see clearly on this screen evidence of a very large IPO premium during the dot-com bubble, and we can also see some other periods through history where there were hot IPO markets. That is, these tend to be periods where market returns are positive and when there's a lot of IPOs being issued, that the premium is much higher. We see this time-varying nature where it's definitely not constant throughout time. So as well as being diversified across IPOs, it may also be important that an IPO investor either seeks to time the market or is diversified through time. So thinking about the performance of IPOs, it was mentioned previously that initial public offerings tend to subsequently underperform over the long run. One demonstration of this is the bar chart that we see on the screen, because what we're looking at here is the period after that first day, after that positive premium is experienced. What do subsequent returns look like? Well, in this case, the blue bars represent the average returns of stocks 1, 2, 3, 4, and 5 years post-IPO for those stocks that list on the market. And the red bar represents the average return in the subsequent 5 years for non-issuers. The key takeaway from this is that blue bars are lower than the red bars. That is, that over the 5 years post-IPOs, we find that those shares that do initially list on the market subsequently underperform over the long run. Again, getting back to the point from earlier, this is a trading strategy that does involve a very frequent turnover because the shares have to be sold not long after the initial public offering. Now, there's a range of issues that we are confronted with when we consider IPO investing, and the most prominent of these issues is known as the winner's curse. That is that of the 13,000 initial public offerings that we spoke about before in the sample of academic studies, as an individual retail investor, you are not necessarily able to access all of these initial public offerings. This is because the way that the IPO generally works is that preference is given to priority clients, and these tend to be either a broker's client who does a lot of business with a broker, or maybe institutional investors who are able to buy big blocks of shares at the one point in time. So because we've got priority given to professional investors, many of the best performing IPOs will be fully subscribed before shares are actually available to retail investors. This means that the shares that are left over and available to retail investors are those that the professional investors have elected not to invest in. So these tend to be the IPOs that have poorer fundamentals and subsequently actually don't perform as well. And that's where we get this name, the winner's curse, from, because as a retail investor, the times where you win, that is the IPOs you are actually able to subscribe to, tend to be cursed in the sense that these are the IPOs that professional investors have elected not to buy into, and often they actually perform poorly because of the poor underlying fundamentals. So if we're thinking from the perspective of a retail investor, is there a particular category of IPOs that retail investors might be able to access and have equality in terms of their ability to access shares in that initial public offering? Well, the answer is yes, there is one subset, and they tend to be government IPOs. So over the past 25 years, the Australian government has privatised a large number of businesses, and one key feature of these government IPOs is that government often will set up the initial public offering such that there is equal pro rata access to all investors. So that is that individual retail investors will effectively have similar access to institutional investors, because there'll be a large block of the shares that are set aside purely just for the mum and dad investors. So given this is a subset of initial public offerings not affected by the winner's curse, that is, retail investors often have just as good access to these initial public offerings as the institutional investors, it might be important to ask, well, how historically have government initial public offerings performed? On the screen here, I've got a list of prominent government IPOs from the last 25 years. What we can see that across these initial public offerings, all but one of them had a positive first day average return, and the average one-day return across all these government IPOs was about 10.83%. So there is strong evidence that there is an IPO premium in government IPOs as well, and as discussed earlier, for retail investors, this is probably the segment of the IPO market that can be best accessed. So last of all, what are some of the determinants of IPO investing? Well, first of all, because not every initial public offering does generate a premium, it is important that investors undertake careful analysis of the prospects of the firm. So this involves strong valuation skills and analysis of the financial statements that are included within the prospectus, so that you can identify those particular stocks that have the best financial prospects. Now, since this IPO investing is a short-term strategy, you will need to get a gauge for market mood and demand for each offering. As discussed earlier, there tends to be hot IPO markets where the average premium is higher, so the investor will need to try to determine whether we're currently in that phase. And also, we spoke earlier that the IPOs that are most likely to earn a positive premium are those where there's strong demand or oversubscription. So the investor will also benefit if they can get a gauge for the demand of each offering. In many instances, and particularly here we're talking about government IPOs, but IPOs generally, investors will want to play the allotment game. So that is, when an initial public offering is oversubscribed, investors will often receive a scaled back or prorated amount of shares compared to those which they applied for. So if you want a certain amount of shares, often it is beneficial to actually apply for many more shares than what you actually want to purchase, with a view that the oversubscribed initial public offering will be prorated back, and that will enable you to purchase the desired amount of shares. Also important to remember two possible drawbacks associated with initial public offering investing. One is, given the short holding period, that transaction costs are going to be quite prominent here. And two, as discussed earlier, issues with the winner's curse because of the fact that retail investors often won't be able to access those initial public offerings that have the best prospects.